Lots of people making claims over there that they can predict the market 100%. Now, I would ask anybody listening to me, do not believe in such claims. There's no way somebody can 100% predict the market, even the AI. And using an AI to predict the market is really, really hard. It's possible, but it's not everyone's cup of tea.
All right, Dr. Matloob Khushi, looking forward to talk about algo trading today with you and really how we're able to use AI now for trading and how that's going to work. You've been doing a lot of research on that kind of stuff. So look forward to kind of see where you're at in terms of trading and algos these days.
Thank you very much, Etienne, for having me. And that's the topic I'm very much interested in. That's my bread and butter. That's what I do all the time. So probably be happy to take your question and then take it from there. How's that?
Walk me through how you got introduced to trading and especially algorithmic trading and then AI into trading as well. How did you start to go into that?
From the student's point of view, how we teach it to the student, because I'm a full-time and academic. I'm an associate professor at Brunel University of London. So my full-time job is to teach, supervise students from undergraduate up to the PhD. So we have a recent PhD completion in this trading domain as well. So yeah, I'm gonna be more talking about from that point of view. How do we train to a student to be a world's best trader in an algorithmic trading? So we teach basically basic concepts of trading, the support and resistance, candle charts, stuff like that, various indicator, technical indicators, stuff like that. And then we expose them to the well-known trading strategies, look for like fair value gaps or Bollinger Band reversal or trend trading, introduce them to the concept of scalping, swing trading, and then based on the person's the flavor, what they want to do, whether they want to be a day trader or long-term investor, so we expose them different trading strategies, and then we bring into the AI. Then at the same time we teach them different AI algorithms, machine learning, neural network, stuff like that, and and then we teach them how to bring the best of both worlds together, merge them together, like rule-based algorithms, and then neural network and machine learning, more kind of black box, and then learning on top of it, and then predicting and forecasting where the market's likely to head. And we also have some strategies where we do the arbitrage, like the price difference between different exchanges. It used to be a lot more in olden days, but still these gaps appear between different exchanges, especially in the crypto markets. So we trade those strategies, basically taking benefit all from the inefficiencies between the different markets.
A lot of the trading principles by default are kind of more discretionary, like support resistance area, as you mentioned. These are kind of hard to code. How do you bridge the gap between things that you cannot or that are really hard to code into an algo?
Yeah, so that's where AI comes into handy. So we throw in the AI will not really going to predict whether what is the support or what is the resistance, and neural networks are very good with that. And lately, we even employing large language models to predict the movement of the market. So basically, we will have an algorithm, and you obviously, based on your taste, you will have your stop loss and take profit in your mind or in your strategy, and then you train your AI on a historical data on the same asset class, same time frame, very very large data, and then you after that training, you ask is the probability of hitting your stop loss. And if the probability is really high, maybe it's not good to go into the trade. And obviously, you test these algorithms beforehand. Um, for example, you can train on 2000 to 2024 data as your training. Then 2025 data could have your um, validation testing set on unseen data. You test it on that, and then on 2026, then you can start doing the real trading after you have a confidence on your completely unseen, untested data. You test it on those data set, then you can start employing them into your real trading.
So if I understand this right, you kind of have the algos that are coded. It's like very hardcore rules, and you might have the AI that acts as a filter for these rules, or is that kind of telling it to trade or not trade in certain sets, or how does that work together with the code?
Yeah, the way it works. For example, you might have a strategy. Let's talk about very simple. You're trading in a market where the reversals are very common, like as forex. Many people trade mean reversal. They believe the market gonna come back to mean. So, like, let's say your strategy is Bollinger Band, price going up to the upper Bollinger Band, and start to show signs of reversal. Then you short. Now, what you do that you collect that if you want to bring in like AI, you go back whatever maximum time frame you can go back depending on where you get the data. So you ideally you should go like 10 years of data, but if you can't, like 5 years of data. So you fetch that 5 years of data, and then you implement that strategy, back test it. So you will have your wins and loses on that data, right? So those wins and loses will act as the labels for your AI training, if that makes sense. Yeah. So then you train your AI on that 5 years of data with your wins and loses. Obviously, you don't want to trade for the losing trades. And then you test it on unseen data another year. So same strategy, you apply the strategy, and then you have two systems now running in parallel. You have your mechanical rule-based strategy predicting, and now you have your AI predicting whether you're going to hit your stop loss or take profit. So you have two systems. So you test it on another year, let's say, and then you will have the real probability of winners and losers for your future markets. I mean, if it sounds too complicated, then it is. It takes time to learn, implement, get your strategy right. But in a very like a high level ground, I think traders such as yourselves will probably be doing trading for a long time. It probably can make sense to you. But the people who are new into the trading, that probably be too complicated for them. But yes, it is a complicated domain.
I think it's getting easier and easier to use AI for traders too, and we can get into that a bit more in details later. But I'm kind of curious to know what kind of data the AI use to make decisions on trades that should be taken or avoided. Is it based on just prices and like price data, or are there other things that the AI tends to look at for decisions on trades?
Now that there are mainly two domains where we kind of academics working in is one is purely like a research based domain where we want to publish a paper, we want to see how AI can be improved for the prediction purpose, invent new algorithms. So, and then the other space is where you really want to use that for making money, do real trading. So for the first domain, it could be like I have published paper along with obviously with alongside with my students, uh, just predicting markets based on the sentiments, like on Twitter tweets, how people expressing their sentiments about against a certain asset, and then we extract those sentiments, and based on those sentiment, we correlate with the prices and see if we can predict that. In another paper, quite a few years back, we extracted quite a few different fundamentals, like for the stocks, earnings, their earning to price ratio, and analyst rating, and I can't remember from top of my head. There were like 40, 50 different indicators, um, fundamental indicators, alongside the technical indicators. And what we discovered uh, in that research, that the analyst rating is a good contributor for predicting the movement of markets. Yeah, I can say the same thing again, probably. Like, yeah, in terms of research, we research so many different market and so many different indicators, including fundamental indicators, like analyst ratings, and fetching the real data from the company's profiling, like what they report after every 3 months or so, and then use that data to predict the future movement. And in that paper, we found the analyst rating was contributing a lot in predicting the real markets. It was a big predictor along with some of the other indicators. Yeah, these papers, if somebody Google my name, all of my papers comes up in a Google Scholar. They can see those papers, read in more detail. Some of the indicator I don't remember from top of my head now. But yeah, I remember like the analyst rating was one of the big contributor in predicting that. And then we also published a research where we shown that people's sentiment really drive the market, whether it's a real movement or a fake movement, but it does reflect people's sentiment are correlated with the future market movement. So that's a research side. For the real trading, what we have observed that these kind of um, sentiments could be used for the long term. That like using these sentiments to do a day trading gonna be really hard. For the day trading is more better. Price action kind of strategies are better suited for day traders.
Are we getting to a point where anyone can use AI now? Or is it still kind of reserved to people who know how to code, who know how to do a lot of analysis manually, or is it kind of getting to everyone now?
No, 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 no. It's I can with my 10 years of experience in this particular domain. I'm in academia for last 25 years, but in specifically in the trading and using AI algorithm, I've been doing that for last 10 years. I can bet on that. It's not a cup of everyone's tea. It's very difficult, and people feel like it's very easy. They can use the AI to predict the market. You can't. Is still very hard. You can people using very simple methods like taking the screenshot of um, charts with a lot of bunch of indicators on it, and then feeding it to chat gpt, and then publishing videos. See, I made so many hundreds of thousand. Yeah, all of these claims are not real. You can I can bet on that. I can bet on that. Lots of people making claims over there that they can predict the market 100%. No, I would ask anybody listening to be do not believe in such claims. There's no way somebody can 100% predict the market, even the AI. And using an AI to predict the market is really, really hard. It's possible, but it's not everyone's cup of tea.
The models that you need for using AI in trading, are they the models that people have access to, like ChatGPT or these other platforms, or is it something more complex? You need like a bigger model to be able to make decisions on trades.
it's more like kind of you need that real trade, like the back testing, really put an emphasis on doing a back testing, like or whatever model you want to use. Like when you use the ChatGPT, the problem is ChatGPT or any language model. The problem is they have an access to the future. You can't back test them, right? Because they have already seen the data. Uh, so that's really a big problem in this industry, and I've seen that a lot of published paper out there, they're using that they have the problem of this data leakage, like using future data to predict the future prices. And that's what the chat gpt and all the language models do. Like if you take a screenshot of 2025 and remove all the dates there, you would think that the model wouldn't know that this is the 2025 prices, but they do. um, they can correlate that screenshot with their knowledge base, and then whatever they will predict, they will be utilizing that knowledge base that they already have in their memory. So it's gonna look uh, very like, oh, you see that ChatGPT was able to predict the market. It didn't know the context. It didn't know blah 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 blah. But it can't. It's actually making use of that data leakage. Is a problem. Like it's not a real performance. What if you want to do? If even if you download the large language, like if, for example, if you download the Facebook Llama or any open source model, yeah, and then you use it to train. Like now you can say, oh, it's not my local, but still, it's the same thing, because those, if as long as you using their open source weight, you feeding in the future information. Yeah, unless you train those models from scratch, which most people can't because it's too technical. You need big computers. You probably need $1 million to do that training. So unless you do that from scratch, you cannot rely that. And I'll bet that those predictions will fail in the real market, and you will lose money if you bet on that.
Definitely. You talk a lot about people using AI as like a black box and not really understanding what it's about and how to really train AI. Do you want to kind of go more into how that works out?
The reality is, more when people say AI these days, because of the recent like rise of ChatGPT and other large language models. So for them, that this is the AI. So when they say we're using AI, basically they're using these models online. Whereas using a real AI thing is difficult, and you need a, a lot of training. You need to spend a lot of time to really train some algorithms to predict something. So these models, especially the online models, they are. I wouldn't say you rely their prediction, um, for because you haven't done a proper back testing, and you can't do a back testing with these models, with these online models, because there's no way you can go into the past and then um, not run into the data leakage problem. So unless you have your own models running locally, not being exposed to the future data, that's a big problem. You need to make sure that you're not doing that, and then you do the back testing. And once you have the results from those back testing, you have your confidence score, you have your probability score, then you know how well they're likely to work well in the real market.
What kind of confidence level do you need to move forward with the system?
I'd look for two main indicators. There are many, but for me is and for different people it could be different. But for me, the main thing is profitability and drawdown. And the probability score, I'm looking at minimum greater than zero point 0.8. That the algorithm is kind of 80% sure that this is going to happen. Sometimes, the um, algorithms predict based on even 51% surety. Like, then at least you would know that the algorithm is not really confident while it's predicting this. So that's why it's very important to know the probability score and the confidence score, that how confident the model is about something. So during the back test, I'll look for the drawdown, what, and that will give me an indication of how much money you are likely to lose. Yeah. So that means if something goes wrong in your real trading, then that's where you want to stop. There might something has terribly gone wrong. So drawdown will tell you that much money you're likely to lose in a worst case scenario. And the profitability, um, that's up to you, but the minimum I would like to have my algorithms to perform like a 70 to 80% return annually. Yeah. So the best fund in the world, like the Medallion Fund of Simon Jim J, they were making like 50 to 60% per year. So yeah, if I have an algorithm that can give me a probability score and a confidence score greater than zero point 0.8 with a 70%, even I'm happy with the 60% plus minus. Then I'm happy to try these algorithms in the real markets. But many people aim for 10 to 20% return per month. I think it's very difficult to achieve. And it's possible, depend how much risk you want to take. So if you one thing I like people to realize, if you're trading with $100,000 and you want to make 100,000, then you're ready to lose 50,000 at least. You should be ready to lose at least half of it. So if you're ready to take that risk, then yeah, you go for it. So that's, then everybody should know their risk appetite, how much risk we want to take. And the other thing I really stress on people is it's not a similar experience trading with $1,000 and trading with $100,000. Making $1,000 into $2,000, you can do it. Yes, probably, and you might have done it in the past. Yeah, but turning 100,000 into 200,000 is really, really difficult. It's not the same effort. It's not the same effort. And you can experience, you can share your experience with that. So these market, they don't like linearly correlate. Like the algorithm, what I'm trying to say is, if you have an algorithm that is working well on $1,000, there's no guarantee it's going to work the same way on $100,000, because the moment you make a big trade, you're shaking the market. And there are market makers out there, and many traders, they manipulate the market. Many brokers manipulate the market. If you are a big trader, move they could move the market against you. And this is something that people don't really realize.
Once you have a system working, do you need to put some more work into it? Do you keep to kind of have to work on it again, or is it running and kind of working forever after that?
Yeah, you have to continuously monitor a system. And yeah, I spent actually years and years on making a universal algorithm that works across different time frame and different asset classes or different financial market. But at least I couldn't succeed. So what I have learned, that you have to have an algorithm for specific asset class, specific time frame, and they need to be fine tuned, looked at again whenever you feel like it's not performing the way. That's why you need to know your drawdown, your historical drawdown, and the money that your algorithm likely to lose. You need to know that. If the algorithm ever falls apart, then it's you're not supposed to lose that much of money. Then you can stop, rethink, check your algorithm, check the markets. There could be some, even like in the recent time we've seen something really, really bad happened, like during the Ukraine war, people lost a lot of money because, yeah, that sudden event that wasn't supposed to happen. Even the day before the Ukraine war, Russia was saying, "I'm not gonna invade." So traders were not ready for that, and that suddenly. So if your algorithm suddenly lost the money, which is not supposed to, then at least you know, and then you can go back, look for the fundamentals, whether the fundamentals have changed, whether there's some big news happening, suddenly Trump out of office, or what, the country invading on another country. These kind of big news have um, big effects of market, whether it's a good or bad for somebody. So yeah, it needs a continuous, to answer your question, continuous monitoring and continuous fine tuning, refinement.
A lot of people, when they think of algos, they think that they just code, so there's no emotion behind trading. It's easy for them to just let it run. How much emotions affect your results in trading with algos and AI? Do you feel like it has an effect even with everything coded, or is it kind of completely absent from your mind?
Yeah, that's one of the big reason that I actually ask people to switch to algo trader trading, because of these emotions and sentiments. And I have many examples in the past where I gave people very, very strict instructions. They were doing trading for me. You're not supposed to lose that much, and that's how you enter. But there were always instances where they were not following those rules and following their emotion. They were correct some of the times, and that was their excuse for not following the order. You see, the market moved in my direction. You see, if I would have stopped here, I would have lost this money. Now the market returned back. Now I made this amount of money. So that kind of the emotion, and that kind of the reward that you get to follow your instinct, it's a trap. It's a trap. And I've seen, um, at least it didn't work for me. I have seen, whoever I know, it didn't work for them. But if they switch to algo trading, it tend to work for most people. Then you are out of emotion, you have a strict algorithm, and then you know your boundary. Again, I'm going back to the same thing again and again, like basically then you know how much money you're likely to lose. And if your algo is losing that amount of money, then you can still sit back, relax, because you know that you are already mentally um, kind of accepted that yes, this amount of money it is likely to lose. But if it lose more than that, then you can stop it, you can revisit it, you can do the fine tuning. But I would suggest not to bring the emotions in. If you need to change the algo, then you go back to same kind of exercise of doing all the back testing, doing all the refinement, tuning, blah blah blah, and then you implement again onto the market.
How many algos are you able to run at the same time? Do you have a certain limit for that, or is it just kind of based on what you develop and you come up with?
No, like you can run as many algorithm you want, but basically, um, I have two type of algorithms: one for the trending market and one for the ranging side market. Yeah. Uh, but what I suggest people who are already into this domain, I would suggest them not use the same broker for all of your algos, because it's very difficult to catch brokers doing the wrong thing. But I can for sure, very confidently, I've done a lot of research on this. I can say confidently that most of the broker do bad things, and they manipulate the market. So don't have your algos running all with a one broker. Spread out your money, different exchanges, different brokers, and have different, uh, like it could be the same algo, but have it running on a different accounts with different brokers and different exchanges if you are in the crypto.
do you find that all brokers are good at running algos, or is there certain brokers that just don't work well with like the time for execution and stuff like that? Do you see any issues with that?
I don't want to shout out and speak in favor or against anyone, any specific broker. But it's mainly like your preference of language. Like I like using Python. If the exchange or broker supports direct integration of Python, yeah, that's good for me. Like if you use another, like if you use MetaTrader, if a broker doesn't provide the MetaTrader, then yeah, like I know there are quite a few other platforms out there. People use that Ninja Traders and C Trader, and there's so many others out there. So yeah, like it all depends on. Uh, but I think lately the Python is becoming more and more norm, and the good thing with the Python is like then you have an ability to switch the trader. Some of not the trader, like a broker. I mean, so some brokers have their proprietary softwares, and if you have written your algorithm in that software, then you're kind of stuck with that broker. But if you have a main algorithm written in Python, then lots of brokers support it, and more and more coming into the market who supports the Python, then I think it's good. It's good to learn this language. I would stress on language rather than the broker. Like um, Python probably is a go-to language these days.
Not to get too in depth on that, I think people will be confused a little bit, but it's been good to talk about AI and algos with you. I really appreciate your time that you gave here for the listeners. I think people are gonna have some questions. They can always comment below the questions there. We'll put the details of your paper below so people can reach out to you and see a bit more about the things you've researched about and how AI really plays a role into trading. So it's gonna be good for you to see that. I want to thank you for your time, Dr. Matloob Khushi, and look forward to discussing with you maybe again in the future.
Thank you for having me, Etienne.